We have hopefully 4 presentations today. So let's start off with random walks and Wiener processes.
The concept of both random walks and Wiener processes actually originates beyond the financial realm. The term random walks was first coined by Carl Pearson in 1905 in a letter in which he modeled the distribution of mosquito infestation throughout a forest. The term Wiener processes is actually more commonly recognized from Einstein's paper on Brownian motion, in which he looked at Robert Brown's findings of pollen movement in water to prove the existence of molecules. As a result, the terms Wiener process and Brownian motion are often used interchangeably, and we'll use this notation throughout the rest of the presentation. But beyond these two examples, the concept of random walks and Wiener processes are really prevalent in a variety of fields. We have examples that we see in heat transfer, in diffusion, even wireless networking, genetic drift, and psychology. Initially, we had all these concepts developed, but they all existed sort of in isolation within their respective fields. It was in 1900 when Louis Bachet published his paper entitled The Theory of Speculation, in which these concepts were applied to the financial industry. One of the main points in his paper was that the stock prices represented the data and the news of the past, and therefore the past stock price is really irrelevant to the future of that stock or that asset. We now recognize that this idea is really a combination of the efficient market hypothesis and the Markov property. And we'll touch on both of these within the upcoming slides. So while Bachet published these thoughts in 1900, it wasn't until 73 years later when Burton Malkiel published his book A Random Walk Down Wall Street that this really became a mainstream thought. This was the start of one of the core teachings in finance, and since then there's been over 10 editions of this book in publication. And the book continues to serve as both a foundation for investors as well as a platform for debating some of these investment theories, as seen with the counter publication, A Non-Random Walk Down Wall Street. We can see that both random walks and Wiener processes have a wide range of applications, but what are they? So we touched on this a little bit in the previous slides, but let's break it down a little further. So a random walk can be used to describe random movements or movements that can be perceived as random, such as present with stock pricing. A common analogy that's actually used when discussing random walks is that of a wandering drunk. So if you suppose that a man stumbling drunk back from the bars, every step he takes, he has a decision to make. He can go right, he can go left, he can continue to stay on track, and really he has an infinite amount of options. And when you combine this with his drunken state, it represents the random variable in our process. Now, as a man continues to walk and continues to take more and more steps, we would begin to see that his distance traveled resembles that of normal distribution. Now, if we substitute stock price for steps, we get the random walk Wiener process as we apply it to finance. So we have this graph here on the right, and it shows a similarity between Brownian motion and random walk model. You can see that the general shape of the trend for both are the same. However, the Brownian motion shows a greater variation or noise, and oftentimes as a result of this, we look at Brownian motion as a random walk, but with a step size and a time interval that approach zero. Therefore, as far in as you want to zoom in on Brownian motion, you'll still see those random effects. These characteristics of Brownian motion bring us to the next item, which is stochastic process. All this really means is that the values of this process change in a random fashion. Because random walk and Wiener processes are stochastic in nature, we can't just evaluate them as an ODE, but Rather, we need to use stochastic differential equations. And this in turn leads to Ito's lemma, which basically is the chain rule but for SDDs. And it shows us that both the drift and diffusion components within the price fluctuation. Manner in which these SDs are evaluated is referred to as Markov process. A Markov process is one in the value of the future time is only dependent on the present state. The rationale behind this assumption is really depicted in what we refer to as efficient market hypothesis. And this states that all current information is available and it's already been considered in the stock's price. Therefore, the only information that's really needed to predict the future price is what we see currently. And essentially, all these terms, all these items, they can be reduced into a few key points. So, first off, movement of stock prices can be modeled as a random event. Now, someone might argue that the events affect stock prices, they're not really random. Historical data, however, shows that the random assumption is sufficient. And secondly, as we say with the Markov property, there's no market memory. So the price of the stock, where it's at today, that price is going to dictate what the price is tomorrow. All that data they had in the past, the present data that's open to the public, and even that's private within a corporation, has already been incorporated into the stock price. From a mathematical standpoint, we have the equation here for the Wiener process at the top of the slide. The first term we have is what we call the drift term, and the second being the diffusion term, which really depicts the Brownian motion that we've been talking about. So you can see from the naming conventions kind of the origins of this equation. Like we talked about earlier, you have drift and diffusion, which are very inherent to your obviously diffusion and your heat transfer problems as well. So the noise that we saw on the graphs in the previous slide are represented in the equation by the dWt term, which is actually the white noise. In order to use this model, there's also a few assumptions or characteristics of Brownian motion that we must apply with. And these say that the increments we use must be normally distributed, they must be independent, and the function must be continuous in time. For a specific case of Wiener process, we actually have Black-Scholes option pricing equation, where nu x and sigma x represent the A and the B from above. We've talked thus far a lot about the theory and fundamental assumptions of random walks and Wiener processes, but the question that's always most relevant with finance is, how can we use this to make money? So the whole concept of random walks, it really advocates for index funds. With random walks, we accept that we're not really able to beat the markets on a consistent basis, so why would we try? We'd be better off investing in index funds that are geared to match market performance rather than trying to do something on our own or invest in a different sort of fund geared to try and exceed the market performance. From a modeling standpoint, the random walks also allow for us to look at long-term investments, such as a 401k. With these assumptions and the theory of random walks, we're not concerned about daily fluctuations in stock prices or changes that might be affected by news or different societal trends. We're able to use random walks to determine the investments we need to make now and have a fairly strong model of what that's going to be in let's say 25 years. When we look and when we talk about applications of random walks and investing and looking to really invest in index funds, some of you might be sitting there thinking, well, this isn't really the way you're gonna have a big break. We hear stories about people who invest in companies like Google and Apple back when they first came to market, back in their startup days, and they've had huge financial gains from these investments. And then on the flip side of the coin, there's those people who had their portfolios completely leveled by poor investments or poor companies such as Enron. And this starts to touch on some of the arguments that we see against random walks. But people will look and they'll say, well, there's no way that you can say a stock or an asset is random and that you can discard the product or the service that a company provides or the leadership of the company and or even the financial records. And if you kind of look at it along those same lines, they'll say, well, the history of the company's stock performance, that has to have a significant influence on the future price, and that's arguing against the Markov property, and instead saying that ideally you'd have access to all the historical data before considering an investment. And when we look and we talk about historical data, a lot of times we think of the graphs, we think of the charts that are associated with stock price. And one of the ways that people often look at and try and predict, choose investments are through charting trends. And this is often referred to as actually an art rather than a science, but it's looking and visually analyzing market trends in order to find the right time to buy or sell. We mentioned earlier in the presentation the counter to Machiavelli's random walk down Wall Street and how this worked, and tried to convince people that the idea that the market follows random walk behavior is really old and outdated. So I wanted to highlight a quote we have here at the bottom from Business Week article about this counter argument from the book Non-Random Walk Down Wall Street. And this reads, people who devote enough time, money, and brain power can beat the market by finding undervalued companies or discovering persistent price patterns. And this really fully embodies the whole argument that we see against random walks. Whether you're one of those active investors that are really convinced that you believe in the arguments against random walks and you think you can beat the stock market through research, or if you're a sole believer in index funds and in the random walk theory, it's really hard to argue against the profound impact that the random walks and Wiener processes have had on investment thoughts and theories. From starting off modeling mosquitoes and molecules to looking at 401k returns and trying to predict investments, these ideas really suggest that the markets aren't just something that we as humans get in control, but rather they represent the inherent randomness that we see within nature. Thank you.
So what is high-frequency trading? Essentially, high-frequency trading is a trading platform that utilizes powerful computers to transact a large number of orders at very rapid speeds. The computers use complex quantitative and algorithmic programs to analyze multiple markets simultaneously and to generate, route, and execute orders based on the market conditions. In general, the trader with the fastest execution speeds will profit the most. For a little history about high-frequency trading, in the summer of 1989, Steve Swanson began working on an algorithm for what would eventually become the first high-frequency trading company in the world, also known as Automated Trading Desk, or ATD. His college statistics professor, Jim Hawkes, came up with the idea to utilize predictive formulas to make money on the stock market. Hawkes' friend, David Whitcomb, designed these formulas. It was up to Swanson to transform the formulas into computer code. The system that Swanson developed could predict stock prices 30 to 60 seconds in advance by using stock market data that was sent to a satellite dish. The system used the predicted stock price to determine when to buy and sell a particular stock and could execute a trade within 1 second. This was significantly faster than the brokers on the market floor could complete a trade with handwritten tickets. Each share traded only made about a penny, but with hundreds of millions of shares being traded each day, the profit was substantial. By 2006, ATD was trading between 700 and 800 million shares per day. This accounted for more than 9% of the total market volume in the U.S. Also by this time, other electronic trading firms were joining the high-frequency trading game. Recently, high-frequency trading has been in the spotlight. For example, the flash crash. On May 6, 2010, the Dow Jones Industrial Average experienced a decline of 998.5 points in a matter of seconds. This was the biggest one-day decline on an intraday basis in the history of the Dow. Many believed it to have been caused by high-frequency trading and called for regulations to be enacted to better control high-frequency trading. It was later shown by the SEC that high-frequency trading did not directly cause the flash crash, but it did exacerbate the problem. Rather, it was a combination of the evolution of the financial markets and the involvement of competition, regulation, and technology. There has been some regulation enacted to control high-frequency trading. Many view high-frequency trading as giving an unfair advantage to those with the fastest computers, and it drives those in the industry to spend money on faster technology rather than investing that money in improvements to their trading strategy. On the foreign exchange market, one of the two dominant trading platforms, EDS, has suggested scrapping the first-in, first-out principle. This principle gives an unfair advantage to the fastest computers. As an alternative to first-in, first-out, EDS is proposing a new plan that has incoming orders grouped together and processed at random. Recently, in Germany, the parliament adopted new regulatory requirements for both algorithmic and high-frequency trading. They require the traders who are trading on the German regulated markets to be subject to a license requirement. This requirement imposes conduct of business rules and specifies the definition of market abuse. It would seem that in today's highly computerized world, it would be easy to sort through all of the electronic data to see how high-frequency trading affects the market. Unfortunately, it's not that simple. There have been many studies on the topic of the effect of high-frequency trading on the market, though they often contradict each other. Most of the concern is regarding the retail investor. This is the individual whose retirement savings are in the market or who invest in the market in an attempt to beat the low interest rates of a savings account. According to the New York Times, it was found by a top government economist that high-frequency traders were taking significant profits from the retail investor and other investors who are not using computer algorithms. In some cases, the high-frequency trader can make twice as much profit when trading with a retail investor rather than a large institutional investor. Due to studies like this, the general consensus is starting to become that the small investor cannot make a significant profit in this environment. This feeling can be seen by the large amounts of uninvested cash that investors hold. The problem has even forced some high-frequency traders to look to overseas markets to find the liquidity that they need to make their profit. There are many strategies that high-frequency traders use to profit on the market. One of these is ticker tape trading. What this is, market data such as volumes and quotes contain a lot of information that can be used. For example, a high-frequency trading computer can watch the flow of quotes and extract information that hasn't yet been broadcast to the general public. This strategy is completely legal since all quote and volume information is public. The computer can recognize the beginnings of a significant order being placed in the market. This could be from something like a large order from a pension fund, which can take place over several hours or even a few days. During this time, the price will rise as the demand rises. A computer can attempt to realize that this is happening, buy as much of a security as it can, and then sell it back to the pension fund at a profit. With the introduction of dedicated trade execution companies, this strategy has become more difficult though. These companies provide optimal trading for pension and other funds. They are designed specifically to remove the opportunity for arbitrage. Another strategy is market making. This strategy, known as market making, is capable of earning the bid-ask spread. Typically, a market maker is a broker-dealer firm that will accept the risk of holding a certain number of shares of a specific security so that trading in that security may be facilitated. An individual market maker competes for a flow of customer orders by displaying buy and sell quotations for a guaranteed number of shares. When an order is received, the market maker uses its own inventory to immediately sell, or alternatively, it will seek an offsetting order. As a part of the operations of the NASDAQ, there are over 500 member firms that act as market makers for the NASDAQ. They keep the financial markets running smoothly since they are willing to quote both bid and offer prices for an asset. This helps to add liquidity to the market. Another strategy is trading ahead of index fund rebalancing. The majority of retirement savings in the U.S., such as individual retirement accounts and 401ks, are invested in mutual funds. The most popular of these funds are index funds. Periodically, index funds must rebalance or adjust their portfolio to match both the most recent prices and the market capitalization of the underlying securities in the stock or other index that they are designed to track. Algorithm traders can anticipate and trade ahead of stock price movements that are caused by mutual fund rebalancing. This allows them to make a profit on the advanced knowledge of large institutional block orders. Unfortunately for investors, this results in profits being transferred to algorithmic traders instead of themselves. It causes investor returns to be lower than they would otherwise be. Another strategy is statistical arbitrage. This takes advantage of temporary, predictable deviations from stable statistical relationships among securities. The simplest example involves two stocks that are related to each other. In general, the rise and fall of each stock's price is closely correlated with one another. If one stock is rising, the other is typically rising. If one stock is falling, the other is typically falling as well. Statistical arbitrage traders observe this relationship and react when the stocks get out of sync. They are acting on the assumption that the historical correlation is likely to continue. And the last strategy that I'll discuss is called low latency. This strategy relies solely on ultra-low latency direct market access technology. Computer scientists rely on speed to gain very small advantages in arbitraging price discrepancies in a specific security that is trading at the same time on different markets. Some of these traders utilize microwave technology instead of fiber optics to transmit market data over long distances. This is because microwaves traveling in air only experience about less than 1% speed reduction when compared to light traveling in a vacuum. On the other hand, fiber optic light travels over 30% slower. In closing, high-frequency trading, is it just a faster way to trade securities? Is it changing the way the markets react? Is it hurting the small investor? It's the view of most that high-frequency trading does nothing to help the small investor and most likely hurts them. The exodus of small investors from the market due to the fears of not being able to win against high-frequency traders is not good for the liquidity of the market nor for the economy in general. High-frequency trading may not be to blame for events like the flash crash, but it does make the problem worse. Due to the relative newness of high-frequency trading, regulation is slowly becoming a reality. Regulators are looking to restore the confidence of the small investor by enacting regulations to add some control to high-frequency traders.
My name is Kurt Freeman, and I worked with Kyle Dahlbeck to explore the technological effects on U.S. stock markets, a focus on the volume of the Dow Jones Industrial Average. Today we're going to discuss our team's hypothesis, historical background, a literature review, our team's statistical analysis beyond the year 2000, a critique of our statistical model, the conclusions, and potential future work. Our hypothesis is that dramatic increases and subsequent changes in trading volume in the stock market can be directly explained by the increase in technology. The rationale behind this is that rises in technology since the year 2000 have greatly changed the investment landscape, and based on information presented in this presentation and the report, including literary review and recent statistical analysis, we desire to determine whether certain technological and survey factors can be used to predict or model the changes in average day trading in the volume of the Dow Jones Industrial Average. Throughout the 1970s and into the 1980s, market trading was done primarily over telephone and dedicated private wires. It always required a middleman, either a dealer with direct stock holdings or an investor who was able to work through a broker who fetched the best price available. Phone-based workflows, however, were one of the technological limiting factors during the large sell-off during the crash in 1987, where over 22% of the Dow Jones Industrial Average was lost and a sell-off of volume of 604 million shares shattered previous records. To counteract future bottlenecks, this event prompted the development of small order execution systems and the even larger electronic communication network to create an electronic lattice of networks that gave additional avenues for buying and selling assets. What would be the first modernly defined online investment service was DLI Direct, and that didn't appear until 1988. The 1990s continued the establishment of more firms dedicated to the ECN, and the term day trader became commonplace in the homes of millions. Not only convenience, but cost played a major factor as well. On average, throughout the 1990s, internet costs for 1,000 shares of a stock were 50% less expensive compared to the same number of shares in a brick-and-mortar branch. Additionally, 1991 brought about the establishment of the first concept of off-hours trading on the NYSE. This idea also opened the door for larger trading volumes. Logical trading can only be performed with access to adequate information, and in 1996, the NYSE for the first time featured the real-time ticker, replacing the older system that was delayed by 20 minutes. Now, more than ever, firms and individuals had access to the same information that traders on the floor have. In 1998, two individuals from the heart of California publicly released Google, the now behemoth internet search engine and analytics platform. When average investors gained access to a greater amount of information, there is no doubt that this directly affected the likelihood of more investors to invest, and to invest in larger amounts across all the US-based markets. This access to better data, however, did not necessarily bode well for all investors as a whole. Barber and Odeon of the University of California system agree. Overconfidence, augmented by self-attribution bias and the illusions of knowledge and control, can explain the increase in trading and reduction in performance of online investors. Their findings illustrate that phone-based investors, prior to switching to online accounts, actually outperformed the market by 2%. All things considered, it was technological aspects of the 1990s, not just the bull market, that attributed to substantial growth in stock market participation. The 2000s brought on a huge new group of investors attempting to profit from the internet boom, and even after the end of the bull market, participation in the U.S. stock markets continued to rise. In 2000 and 2001, it is estimated that there were over 200 different firms that offered online trading services, the top 10 of which accounted for 30% of all trading volume across the NYSE and NASDAQ. At this time, it's also estimated that 20 million Americans trade online, representing 14% of Americans with internet and 7.3% of all Americans. In 2001 brought about the completion of the decimalization of the U.S. stock marketplace. For the first time, assets would now be measured in decimals rather than fractions, which had replaced percentages circa 1915. There is potential that this eliminated an intimidation barrier to the average investor that may feel more comfortable and more likely to invest due to the mental block of fractions being replaced by cents. Just as the rise in computers and internet availability allowed easier access to trading, computer algorithms have done the same. These complex algorithms and mathematical formulas allow investors to obtain the best possible price when purchasing a stock without significantly affecting the stock's price and therefore increasing purchasing costs. While this is certainly advantageous, lower transaction costs, faster trade execution, higher trade volume, it can be seen as a detriment to the market as a whole. During the 10s, instantaneous market swings have become more prevalent. Take, for example, the hacking of the Associated Press's Twitter account and the subsequent 144-point drop of the Dow Jones due to a fake tweet in regards to an explosion at the White House. Also to be considered is the 2010 flash crash, the result of a computer algorithm moving over $1 trillion worth of funds in a matter of seconds. According to the USA Today, Jeff Hancock, a professor of the Communication and Computer Information Technology Center of Cornell University, states, "Our trust of social media has reached new levels. It's amazing that things like social media have gone from something the kids do to affecting how the market operates." Another rather daunting statistic reveals that over 80% of smartphone users check their smartphone within 15 minutes of waking up, showing that even a refreshing sleep can't separate smartphone addicts from their devices. This being said, however, doesn't necessarily mean that individuals are taking the plunge into investments at a higher rate just because it's at their fingertips. All of these considered, technology continues to increase and improve, although the market is or has become a dangerous place. A literary review and search was conducted for how stock market volume has changed and how technology may or may not have affected it. There were very few literary resources found. This is either due to 1. The topic is not directly applicable to investors, therefore less research has been done on it. 2. Volume has not been linked to growth in the market definitively. Or 3. A lack of available data. What was considered to be the primary source of analysis and subject that we looked into was a paper written by Vicky Bogan, published in the Journal of Financial and Quantitative Analysis. Upon review, there are several strengths to her paper. 1. The paper illustrates that volume has gone up in the market, and at its root can be traced to the decrease of transaction costs, but also the decrease in information costs, as the internet and technology has driven these down. 2. She thoroughly analyzes interactions effects, controlling them, examining them as second-order terms, and explaining what they mean in the real sense. 3. Meaningful participation in the stock market was primarily considered, not just casual investing. And 4. She also considered an increase in activity from current stockholders, not just new buyers and sellers of stock. Also considered were their education levels. While the paper is very well done and founded on solid rationale and research, there are several limitations. 1. In building the model for analysis, a linear utility function is assumed. We find this not to be true. This assumes a linear link between income and investing. A parabolic or quadratic model is a better fit, as investing has been shown to be subsequently higher for those of greater wealth. 2. She considers many variables in her model. However, many of these variables are highly correlated. No residual analysis was performed or correlation study between variables was considered. 3. The market and volume experienced considerable growth during the scope of this study, ending in 2000. This could be confounding with some of her results. Finding an explanatory variable to control for this would have been effective to determine the effect of these market forces. 4. While it is positive that interaction effects that were analyzed and considered, it is in our opinion that they cannot be practical, especially at the alpha level, or statistically confidence, that is assumed. This led our team to develop additional analyses. Areas we focused on to consider in the analysis are as follows. Continue the analysis into 2012, add population effects, cost of living adjustments, and continuing to see if the impact of computers and internet usage really changed volumes. For our analysis, average monthly volume of the Dow Jones Industrial Average was plotted. 3 groups clearly emerged. 1999 to 2002, growth in the market. This is very similar to the rate and trend analyzed by Bogan, and it is difficult to say that anything has changed from her pre-2000 analysis. 2002 to 2008, market volume flatlined. Part of this effect is a market correction in 2002, but it is also our opinion that the saturation of computers, technology, internet, and inconsistent results from personal investing is the real driver. 2008 to present, declining trade volumes dominates this time frame. While much of this stems from the 2008 market crash and lack of consumer confidence, it is also reasonably assumed that attitudes toward investing has changed over the years, and personal investors have lost money. Therefore, they might go back to brokers and advisors in the brick and mortars. After considering many variables of education, age, market conditions, etc., 4 variables were chosen as candidates for analysis and are plotted here. 1. Computer and internet use. These are consistent with Bogan, but now seem to be tapering off. This effect must be further explored. 2. Population growth. Rationally, more people means more trading opportunities. This variable is a factor in a real sense, but was removed from the analysis due to high correlation with computers and CPI. The last variable was Consumer Price Index. This variable was analyzed to give an aspect of price into the model, account for consumer wealth and cash inflow, and correct in the rise in market prices. Again, the goal was to come up with a simple, practical model for market activity. The model was found to be highly significant, with a p-value far less than 0.05. The output of the model as average monthly trading activity is given on these slides. As the model was found to be significant for each of the terms, and removing an intercept term with no practical significance, the fit of the model needs to be explored. Further model analysis was conducted. The residuals of the model were compared across the dataset. The residuals were found to be normally distributed, show no pattern versus the fit of the data, or versus the time order of the data. Residual analysis is acceptable and gives no indication that the model does not accurately reflect the data. Many times models are driven by high leverage points. This was explored by analyzing charts for Cook's D-values and high leverage data values. The results are acceptable compared to the model, but the year 2000, 2009, and 2012 must be analyzed further. The variables were then checked empirically for high correlation, and this was found to be acceptable to an appropriate statistical confidence. Between the advent of the Dow Jones Industrial Average, trading volume has been on an ever-increasing path. Among the most influential advancements in terms of U.S. stock market trading has been the widespread adoption of the Internet beginning in the 1980s, and especially in the years between 1999 and 2002. The market then entered a stagnation period between 2002 and 2008, where although technologies continued to increase availability to investing, it did not materialize according to the analysis. Dramatic price fluctuations occurring in early 2008 instigated a downward trend of investment activity, almost as sharply as the growth in the late 90s and early 2000s. Because of this, the volume of the Dow Jones Industrial Average on a month-to-month basis remains lower than it was in 1999, and modern trading volume cannot be directly linked to technology, especially not computer ownership and internet access. While we found our model to be significant, that does not guarantee the model is practical, similar to how correlation does not prove causation. There are strengths in the model that have been developed. 1. Simplicity. Only 3 terms, no assumed interaction effects, easily traceable and identifiable metrics. 2. The model tracks well over a market that has changed in valuation and in volume. As mentioned, Bogan's model only analyzes volume over a period of increasing volume. This could lead to a bias. 3. The model is more robust as the computer and internet variables have had a chance to realize their full effects. Weaknesses of the model include 1. A high correlation that may not be fully accurate and may need additional terms to control for education, brokerage factors, and others. 2. Investing age has changed over time, and information costs have also changed. These were not considered. Future statistical analysis considerations could be update the data based on the current bull market trends of 2013. We could also consider other stock markets less familiar than the Dow Jones Industrial Average. Furthermore, we could look at the full saturation of computers and internet usage as time goes on. In addition, we could look at the delayed effects of baby boomer retirement and also control for investment age. Other widespread volume effects to consider. Does the fact that pension plans are being dropped from a large majority of companies today, forcing individuals to increase their personal investments and 401ks? Where is this volume going? To be considered as well is that foreign individuals may also be more inclined to invest based on the same access to market data, further driving up volume. Where is that illustrated? Conversely, could some of the stagnation and loss in volume actually be that pushed into foreign markets, especially BRIC nations? Another interesting point is that selftrade.com surveys illustrate that the portion of investors on its site that are female jumped from 24% to 34% in just 2 years. Not directly related to trading volumes, but important to consider also, is the idea of saving ourselves from our technological selves. Are things like circuit breakers only the beginning? Remember the flash crash of 2010. What about online investing being regulated across the board? Topics like these will dramatically affect the U.S. and international marketplace for the foreseeable future. This concludes the presentation. If there are any questions, we'd be free to answer them as required. All references can be found in our report. Thank you.
Good afternoon. My name is Robert Santana. I'm presenting on behalf of myself, Apurva, and Sid. Our topic of discussion today is going to be hedge fund strategy, so we'll jump right in. First, we're going to give a brief overview of what a hedge fund is. A hedge fund is a managed portfolio of investments that uses advanced investment strategies such as leverage, long, short, and derivative positions in financial markets. Historically, these strategies were used to hedge out risks. Today, these hedge funds stand to hedge out risk and make a lot of money. Who uses hedge funds? They're often limited to accredited investors, those with high net worth, high income, net worth typically over $1 million. The income is typically over $200,000 per year. Where are these strategies implemented? They're often implemented in conventional markets such as stock markets and futures markets, kind of what we'll discuss here today. But they can also be used in unconventional markets such as sport, art, or housing, anything that has financial value and would allow you to bet on where that value is going. How are these strategies implemented? That's kind of where our context of this presentation is going to take us. We're going to break it down into two parts today. The first part will be the investment tools such as derivatives that these hedge fund managers use. And the second part will be where do they use these tools at? How do they pick the companies that they pick? So we'll move right into it. First, I want to discuss the basic call and put options, and we assume you're already familiar with the long and short positions on a stock. First, we introduce what is called the strike price. For the sake of argument, we'll call the option strike price around at $120. For the option premium price of $10, this gives us the option to buy the call for $120 within a given time period. On the other hand, a put option will give us the same type of strike price for a short sale. In this case, we'll say there's $80 for the option price of also $10. Now let's take a look at one of the scenarios for a call option. In a scenario where the stock moves from A to B, you can stand to make a $20 profit where the stock price rose to $150 and we had a strike price of $120, premium price of $10. Now if the stock price goes from A to C, as you can see here, drops down to $50, you simply would not exercise your call option and you would lose the $10 option premium that you paid up front. Now the put option, also the option premium price of $10, as we said. If the stock moves from A to C, and because we're shorting it, then we're making good on our bet, we can stand to make a $20 profit in that same case. Now if the stock moves from A to B, stock rises in value, you simply would not exercise your right to short sell that stock. As you can see in both cases, we had an option premium price of $10, so we made a 100% rate of return on our initial investment. Whereas a normal long and short position, you would have only made 50%. What this is called is leverage. Options create leverage on your initial investment. Now, an essential part of any investment is the profit and loss. Here we show you a profit and loss diagram. This will help you to understand the slides going forward. In the same call option scenario from the last slide, this is what our profit and loss would look like. As you can see, when the stock was at point C, we made a profit of $20, but when the stock went to point B, we lost our option premium of $10. Now the put option overlaid. This shows a similar profit and loss from our put option scenario. When this stock was at point C, we lost our option premium, and when it was at point B, we made our $20 profit. Now these types of diagrams are essential in understanding the different combinations of strategies going forward. One of the tools that a hedge fund investor may use is called a covered call strategy. He would do this in two steps. First, he would take a long position in a stock, and two, he would write a call. We'll say, for instance, that the share price is $50, the strike price is $50. This is an at-the-money call option, and the option cost is $5. The red line is your normal long position value. The blue line is the call writer value. The blue line by itself is also called a naked call. A naked call, as you can see by itself, exposes the call writer to unlimited downside risk. So what the call writer does is purchases the long position, and when he has them both together, you get something as shown now in the red and blue line. You simply add the two lines, and now the call writer has protected himself against the downside risk. Another strategy similar to the covered call is called the protected put strategy. Two steps in this: you take a long position and you purchase a put option. The blue line shows our put option, similar to what we showed on one of the, two graphs ago. This is your profit and loss diagram, and the red line, your long position, that's your profit and loss. Same idea here. If you combine these two, when you combine these two, simple addition of the two lines, you mitigate your loss on the long position, where you could have stood to lose the entire $50 that you invested. Well, now you can only lose $5. Another way to hedge out a lot of the risk. Very popular strategy also. Another important part of hedge fund strategy are futures. Futures are a standardized transferable exchange traded contract that requires the delivery of a commodity, bond, currency, or stock index at a specified price on a specified future date. Unlike options, futures come with an obligation to buy or sell at that future date. Here we have the example of a farmer. A farmer may sell a futures contract for produce or buy a futures contract for grain. In either case, the farmer is trying to hedge against any price movements, either against the produce that he wants to sell or hedge against price movements in, say, the grain that he needs to buy for livestock. In the same manner that we discussed the options as before, the farmer may buy futures options, which could serve as kind of lower cost insurance to hedge against some of those price movements also. Okay, now that we have some of those tools in our baskets, the next question is moving on to part 2 here. How do hedge funds pick these investments? Or how do they forecast, and how do they pick the companies that they do pick? One strategy that a hedge fund manager may use is called a market neutral strategy. In this strategy, the investor can essentially hedge out the risk associated with the market movements. Most stocks tend to have some beta correlation with the market, and as you will see, this can reduce that beta to close to zero. Let's say that we think company A will outperform company B. Well, then we can bet the same amount of money on each. However, we take a long position in the better company A and a short position in company B. Now let's take a look at scenario 1, where the market moves up and A and B follow. Assuming that company A is better and it moves up 30% and B only moves up 10%, this is a 30% gain on A and a 10% loss on our short position, but still we net a 20% profit. Now let's look at the case where the market moves down, scenario 2 here. In this case, A, being a better company, only moves down 10% and B moves down 40%. This is a 10% loss on A and a 40% gain on our short position for B, which gives us a net gain of 30%. And as you can see, in both cases, we ended up making money. One of the most predominant strategies used today is called a global macro strategy. As the name might imply, this strategy takes positions in markets based on macro type conditions such as world economic outlooks, political changes, interest rate trends, emerging markets, and government policies. The company may take long positions in promising macro movement. For example, certain emerging markets may have a high probability of prospering. On the other hand, government policies such as embargoes per se on a product may be a key indicator to short a certain product. Another major category of strategies is called event-driven strategy. In this strategy, events such as spin-offs or mergers may trigger buying and selling. For example, we'll say Microsoft has just announced plans to buy a small software company for $10 a share, and right now it's only worth $5 per share. After the news press, the stock price may jump to say around $8 per share. The dollar value at that time is sort of a gauge on how the market feels about the probability of the deal going through. At $8 per share would indicate that they think it's about 60% likely. Mergers are often announced and then hindered by other parts of the process. In this case, the hedge fund manager has the opportunity to make money on the initial spike and then again on the final movement depending on if the merger goes through. As you can see here, some other things could drive this as well, including external catalysts such as the BP oil spill. That event likely triggers short sales of the BP stock. One opportunity that hedge funds look for are distressed securities. They look for companies that are going through restructuring, recapitalizations, or bankruptcies. Sometimes hedge funds provide large loans to companies and even take decision-making positions within the company to help the return on their investment. Prior to 2008 financial collapse, some hedge funds took advantage of the vulnerable companies such as Citigroup, who were susceptible due to their collateral debt obligations that they held. Another type of strategy that hedge funds use is risk arbitrage. First, we'll define what arbitrage is. It's the simultaneous sale and purchase of an asset to take advantage of a difference in price, essentially making a risk-free bet. Risk arbitrage is often called merger arbitrage and uses in events such as merger acquisitions, liquidations, and hostile takeovers. They're looking for differences in acquisition price and stock price. We can consider the same example where the software company is trading at $5 per share, but this time Microsoft is buying them for $10 a share, but they're using shares to do it. What an investor would buy, let's say 10 shares of the software company for a total of $50. After that merger, the stock would essentially be worth $100. The investor would also short the Microsoft stock. When and if that deal goes through, the investor uses the converted shares to fill the short position. And any difference in value there, because they're kind of banking on the Microsoft stock, dropping a little bit as they absorb the other company. One type of arbitrage that hedge fund managers look for is relative value arbitrage. This is an investment strategy that seeks to take advantage of price differentials between related financial instruments such as stocks and bonds by simultaneously buying and selling the different securities, thereby allowing the investors to potentially profit from the relative value of the two securities. Three major types of relative value arbitrage strategies are fixed income arbitrage, convertible arbitrage, and index arbitrage. The first one, fixed income arbitrage, can be broken down into many different types of fixed income arbitrage, basically where you're looking for arbitrage opportunities, price differentials between fixed income securities. These strategies can get very complex. One source quoted them as picking up nickels in front of a steamroller. For more details on the fixed income arbitrage, we ask that you would see our paper. We'll discuss here today the convertible arbitrage and the index arbitrage. First, the relative value arbitrage. Okay, take this example here. Assume that a company has two outstanding bonds. One pays 8% and the other pays 6%. They're both first lien claims on a company's assets, and they both expire on the same day. Since the 8% bond pays a higher coupon, it should sell at a premium to the 6% bond. However, you can see here, what we give here is an example. If it doesn't sell at the premium, the hedge funds are looking for opportunities where they would buy the 8% bond and short sell the 6% bond to take advantage of any mispricing. The next type of relative value arbitrage is called convertible arbitrage. Instead of purchasing and shorting stocks, convertible arbitrage takes a long position in convertible securities. The idea behind convertible arbitrage is that a company's convertible bonds are sometimes priced inefficiently relative to the company's stock. Convertible arbitrage attempts to profit from this type of pricing error. To illustrate how convertible arbitrage works, a hedge fund using a convertible arbitrage will buy a company's convertible bonds at the same time as it shorts the company's stock. If the company's stock price falls, the hedge fund will benefit from the short position. It is also likely that the company's convertible bonds will decline less than its stock. On the other hand, if the company's stock price rises, the hedge fund can convert its convertible bonds into stock and sell that stock at market value, benefiting from its long position. Another type of arbitrage that's worth mentioning is index arbitrage. Index arbitrage tracks how the futures are trading versus their fair value. Fair value of futures versus the cash index or the underlying stock basket is the difference in cash flows between the holding one or the other. And you see here we got the formula here for the fair value, where S is the S&P stock index, I is the amount of interest paid to your banker or broker to borrow the money to buy all the stocks in the S&P 500, and D is the amount of dividends paid from the companies owned in the S&P 500. The strategy attempts to profit from the differences between the actual and theoretical futures prices of the same stock index. Does this by simultaneously buying or selling a stock index future while selling or buying the stocks in that index. Okay, that about wraps it up for us today. Remember, we've only brushed the surface of some of these hedge fund strategies, many of which can be very complicated, but hopefully this gives you a good idea of how hedge funds operate. Our recommendation for future work would be in the area of government policy. We would like to see hedge funds opened up to educated investors in addition to the accredited high-income investors. There was a new law recently passed that allowed hedge funds to advertise, so you may see it in the next couple of months. Perhaps opening the accreditation rules would be soon to follow. Okay, thank you for your time today.
Yeah, lecture's over. Thanks. Yeah, you can turn it off now. Thanks.